We're going to get started. Once again, my name is Nancy Neerman. I am the Assistant Director of the Education Debt Consumer Assistance Program. I'm here with the Program Director, Carolina Rodriguez. Unfortunately, she's having problems with her camera, but she's there. And just a little housekeeping as we go through the webinar. If you have any questions during the webinar about anything that we're discussing or anything pertaining to student loans, feel free to just type them into the Q&A box. The chat box should be disabled, but type them into the Q&A. Carolina will be behind the scenes answering questions, and we will also break periodically to share those questions and answers with the rest of the group. And everybody will get a copy of the deck and the recording once we're done. So with that, I'm going to turn my camera off and share my screen, and we will start the presentation. And Carolina, if you can just confirm that you can see the screen.
Yes.
Okay, great. So today we're going to be talking about, in addition to just giving some updates and some general student loan information, we're going to be talking about default, delinquency, and collections in light of the fact that the department had, in the last couple of months, said that they were going to restart collections on defaulted student loans. To start with, though, I just want to tell you a little bit about our organization, about EdCap. We are a program initiative of a nonprofit organization called Community Service Society, or CSS. CSS has been operational in New York for over 180 years. The EdCap program was launched in 2019 specifically to deal with the issue of student debt. Student debt is a crisis nationally. It's a $1.7 trillion issue nationally, second largest consumer debt after mortgages. And in New York State, there are about 2.5 million borrowers with about $100 billion worth of debt. And this program is unique. It's state funded. We offer free services in addition to these free webinars. We offer free one-on-one counseling. We offer a number of, we basically are a one-stop shop for all your student loan needs. So in addition to the webinars, we will do one-on-one counseling and help you do things like determining your best student loan repayment options, accessing loan forgiveness, applying for financial aid. That's or FAFSA. That's a little bit of a new service for us, consolidating, deferring, and forbearing. We also will act as your advocates and help you resolve issues with loan servicers and lenders. We can help you get out of default if you're in default, or prevent you from going into it so that you're not exposed to wage garnishments. And then we will also, for those of you that are perhaps thinking about going back to school or have college age kids that are going to school, we can work through the pre-college counseling, the pre-college process, and help you understand your awards letters, and basically try to come up with a strategy for going to school with the minimum amount of debt possible. So let's get right into the important updates. As you, I know, have all seen, the department in April of this year announced that it was going to resume collections on defaulted federal student loans starting May 5th, 2025. Now, remember, for the vast majority of defaulted federal student debt, collection activity has been paused for close to 5 years now. As of the end of May, it's been reported the department collected about $100 billion. But in early June, the department said that it was going to pause collections on Social Security. So there's essentially 3 different ways, for the most part, that the government can collect on defaulted student loans. It's with Social Security offsets, tax refund intercepts, or administrative wage garnishment. There are other ways to do that as well, but these are the primary methods where people are going to see their money taken if they have defaulted federal student loans. So the department did at the beginning of this month say that they were going to pause collections on Social Security. It has not mentioned anything about pausing collections on tax refund intercepts or on wage garnishments, which are supposed to be scheduled for later this summer. In terms of the refund intercepts, if you've already filed your 2024 taxes and received your refund, that should be protected. They're not going to claw those back. But if you haven't filed your 2024 taxes, or you did and you didn't get your refund yet and you're defaulted, you could see an intercept in that situation. There are estimated to be about 5.5 million defaulted borrowers right now. These are people that predominantly defaulted prior to the COVID forbearance. But there are also another estimates of anywhere from 4 to 5 million people that are significantly delinquent at this stage. So remember the on-ramp period, which was the 1 year grace period once we went back into repayment, whereby if you missed a payment, it didn't subject you to any significant financial issues. That expired at the end of October, and starting November, delinquencies once again started counting towards months that if you get to a certain point, you might wind up defaulting. And we're about 2 months away now from people with significant delinquencies being at risk of default again. So we could see by the end of the year close to 10 million borrowers that are in default, which would be about 25% of the total student loan portfolio, maybe a little bit less than that, but that's a pretty big number. So what does this mean for you if you're in default? You may have already received a notice about Treasury offsets, or potentially about tax refunds, and even Social Security offsets. Again, the Social Security offsets are supposed to be on pause, but you might have gotten a bill. Later this summer, they're anticipating sending out those notices for people who might have wage garnishments, which is going to be a bigger pool of people. You may also get an email from your debt collector, which for most of you, if you have Department of Education held defaulted debt, that's going to be Default Resolution Group. If you have these older types of FFELP loans, that might be a guarantee agency called Trellis or EMC. There are about 12 or 13 of those. So they may be offering to have you make arrangements to resolve your defaults as quickly as possible. And we're going to go through this obviously in more detail. Some updates on the SAVE litigation for those of you that are in the SAVE plan. As you well know, this plan is facing legal challenges. There has been a court injunction preventing the department from basically doing anything with the SAVE plan since last July. Anybody that was in SAVE as of last July was placed in a non-interest bearing forbearance. And unless you have taken steps to get yourself out of that SAVE forbearance, you are probably still in it. Interest doesn't accrue. You don't have to make a payment, but time spent in this forbearance doesn't count towards forgiveness. It doesn't count towards PSLF, and it doesn't count towards income-driven repayment forgiveness. But income-driven repayment or IDR applications, which had been brought down for a short period of time, are up and open. You can file online, you can file by paper. You can submit an application if you want to enroll in or switch an IDR plan. Now, processing of IDR plans had been shut down for most of the last year and have just resumed, with the exception of processing and SAVE. So if you're filing these applications, you just gear up. You might be in for a month's long delay in actually getting them processed because there's some very big backlogs. The IRS income retrieval tool, this is the tool that allows you to link to the IRS database when you're filing these applications. It automatically brings in your income. That's back up and running. That had been non-functional for a while. IDR forgiveness, this is the forgiveness program that offers forgiveness after 20 or 25 years of being enrolled in one of the income-driven repayment plans or IDR plans. And when we say income-driven or IDR, that's an umbrella term for these four plans: SAVE, PAYE, ICR, and IBR. IDR forgiveness offers will discharge your loans after 20, 25 years of qualifying payments, and there's no employment requirement. Unfortunately, right now, it seems like IDR forgiveness is on hold with all of these repayment plans, including income-based repayment plan, which is the one that's actually in statute, where they should be offering forgiveness, but they don't appear to be doing that right now. But we'll talk a little bit more about that later. Public service loan forgiveness does remain in place for now. Nothing really has changed with that program yet. So if you're in a non-save IDR plan, you can continue earning credit towards PSLF. Now, I want to talk a little bit about, I'm just going to ask for those of you that are raising your hands, if you can please ask your questions in the Q&A. And we will, if we have time, we'll open it up for people to raise their hands later in the session. So a student loan, I want to talk a little bit about the proposed bills that are going through Congress right now. So there are a number of different things that are happening that could reshape the federal student loan system going forward. There's the litigation that's targeted at SAVE, but has some implications for some of the other income-driven repayment plans as well. That's going through the courts. There's something called negotiated rulemaking process, which is a process that the Department of Education uses to make certain regulatory changes. And then there is the big beautiful bill, which is the budget reconciliation bill, which is happening at the congressional level right now. And of course, this congressional bill, if it passes and if it's signed by the president, would basically reshape the entire system and make all these new proposals law. So right now, these are just proposals. We've had the House bill out for a while. And so we've been able to kind of go through and really do a deep dive on that. The Senate version of the bill just came out yesterday. So we're still kind of going through that. I'll highlight where I note there are potentially differences. The two bills aren't dramatically far apart, but there are some significant differences in different parts of it. So in terms of subsidized loans under the House bill, the plan was to eliminate subsidized loans for undergraduate students. The Senate bill does not do that. It keeps those loans in place. Both bills are talking about eliminating the graduate plus loans. So plus loans for grad students allows graduate students to fund their entire education within the federal system because you can borrow up to the cost of attendance. Both bills are planning to eliminate the graduate plus student loan bills and restrict the amount of borrowing a parent can do. In terms of the loan limits that are printed out here are for under the House bill. So it would severely limit the amount that a parent plus borrower can take out. They can only take out $50,000. It would limit the amount of aggregate borrowing a student can do to anywhere from $50,000 for undergraduate students all the way up to $200,000 for professional students. The Senate bill is more generous in terms of the amount of aggregate borrowing it allows across the board, and particularly allows a lot more Parent Plus borrowing, up to $65,000 per child instead of $50,000 maximum for regardless of how many kids you have. The elimination of the ICR plans, that's the Save, Payee, ICR. New IBR, there's still a little bit of a question about that. The IBR, or the existing IBR plan has two different versions, which is one is cheaper than the other. The new version is cheaper than the other. Both plans seem to be targeting eliminating the newer version of the IBR plan, but don't 100% quote me on that. We have to go back and look at the Senate bill a little bit more. Certainly the House bill is looking to eliminate that. All the income contingent repayment plans that Save, Payee, ICR would be phased out. And then borrowers on ICR, specifically Parent Plus borrowers on ICR, would be moved to the new income-based repayment plan within 9 months of the bill passing. The current repayment options would then be offered to people who take out loans on or after July 1st of 2026. And then it would reduce the number of options that one would have to be paying going forward to one of two options, basically a new version of the standard plan, which would have payback periods of between 20 or 25 years, depending on your loan balance, and you would only have the option of doing a fixed repayment plan. So the graduated plans would be gone. And then this new plan called Income-Based Repayment Assistance Plan, or RAP, where the payments are based on adjusted gross income. Forgiveness in this plan would happen after 30 years instead of 20 or 25 years under the current IDR forgiveness program. The payments you would be paying off, if you make a payment, would go towards interest first, fees second, principal third. The good thing about the new RAP plan is that, similar to the SAVE plan, there would be no interest accrual. So if the payment you're making does not cover the interest, that unpaid interest would no longer accumulate in your account. So that's actually, a small positive. And then for anybody that is making payments that cover their principal, um, payments under $50 would be matched by the government, by the Department of Education, if you're making a payment that actually does cover the principal amount of your loan. So the Senate version of the RAP plan is very similar to the House version. There's a couple of things, though, we have to clarify, specifically one being how they're going to treat spousal income in the calculation. So in the House bill, if you are filing your taxes separately, the payment's going to be based on only your income, which is the case now for all the repayment plans. In the Senate version of the bill, it's a little bit unclear how that's going to be treated. Public service loan forgiveness adjustments. There aren't that many adjustments to the PSLF program in this new bill. So just know that payments under the new RAP plan are going to count towards PSLF, but medical and dental internships or residencies will not count if for borrowers who take out loans after June 30th of 2025. They're going to eliminate economic hardship and unemployment deferment for loans after July of 2025. I'm not sure of the dates that would go into effect in the Senate bill. It might go into effect a little bit later in the Senate bill. And they're going to limit the amount of time you can spend in forbearance to 9 months within any 2-year period, with the exception for medical and dental interns. These, by the way, most of these rules that were in the House bill are similar, if not exactly the same, in the Senate bill. Another potential positive is that for loan rehabilitation, you're going to get more chances if you go into default. Right now, the rule is if you default and you use rehabilitation one time to get your loans out of default, that's it. You can't rehabilitate again. In these current bills, you would be given 2 shots at rehabilitation. And then it's going to repeal or roll back some newer regulatory, basically what have been improvements that were proposed during the Biden administration that have been since then subject to litigation under the Borrower Defense to Repayment Rule and under closed school discharge rules, which would make it just a lot more difficult to get your loans discharged through those programs. Okay, so that's in a nutshell where we're at with the updates and where we're at with these new bills. Remember, these are all proposals at this stage. The House has to finalize its bill, the Senate has to finalize its bill. They have to meet, they have to agree on everything in order for all of this to pass and become law. Okay, so we want to actually, Caroline, I'm going to stop right there to see if there's any questions or anything you want to highlight that I might have missed.
Yeah, so one, administratively, we will send out a copy of the PowerPoint presentation you're seeing right now and the recording to everyone who registered. You'll get that. Give us a couple business days, because sometimes it takes us a little bit of time to get the recording and send out the email. There was a really good question about forgiveness, and I put in the chat a couple resources. One is the link to income-driven repayment forgiveness. We usually call that the 20 to 25-year forgiveness. And whether it's 20 years or 25, it depends on other factors, on the type of IDR plan. IDR is just the umbrella term. And whether it's something like undergrad, grad, for IBR, whether you had loans prior to 2014. So there's a lot more information that I can give you a general. It's 20 to 25 years depending on the plan and whether it was for undergrad or grad. The second part to that question, which I thought was very important, and Nancy, let me know if you've already went over this, is given the safe litigation, the current administration has not automatically been processing IDR forgiveness for people who have reached the 20 to 25 years. Technically, what we know so far is that under IBR, legally they should be discharging loans for folks who are under IBR. But we feel that has also been paused. So I'll leave it there, Nancy. I don't know if you want to elaborate a little bit more on that and what potentially people should be thinking about at this juncture.
Yeah, I mean, I did mention it. One of the issues right now is that we're not getting a lot of information directly from the Department of Education, so there's not a lot of guidance going on right now. But as Carolina said, the IBR plan is the one of those four income-driven repayment plans that I mentioned. That's the one plan that's in statute. The other plans are there by way of regulation, which means that they are more easily susceptible to changes and court challenges. IBR could be changed and may be changed as a result of these budget bills, but the current rule is the law. And for those people that have been reaching their 20 or 25 years worth of forgiveness in IBR, they should be getting forgiveness. It just doesn't appear to us that it's happening. So at this point, if you think you should be getting forgiveness, we probably recommend that you contact, number one, start with your servicer, and make an inquiry. And ultimately, if you're not getting forgiveness, and by law you should be getting, that could be something that you might want to file a complaint with your congressional representative about. I mean, that's the best advice that I can give right now, after you just explore what the servicers and what federal student aid is saying about that program. Okay. So we're going to move on now to understanding your loan statuses. And one of the reasons that we put this in here is that we saw a lot of people when the announcement came out about collections resuming, getting concerned about the fact that they may be subject to collections because of the way it was worded, about, well, if you haven't been paying your loans, you're going to have to start paying your loans again. You know, I'm paraphrasing, but it was something to that effect. People were starting to get concerned because people maybe have been in the safe forbearance for a year or are on a $0 repayment plan and have made payments, and they were starting to worry about that they too would be subject to collections. I want to make it clear that that's not the case. The only way you're going to be subject to collections is if your loans are actually in default. So let's go through the different repayments, the different statuses. If you are in repayment and making your payments on time, clearly you're in good standing. You're not going to be subject to collections. If you're in any kind of deferment or forbearance and you're not making payments, your loans are in good standing, so you are not subject to collections. So that would apply to all of you that have been in the safe forbearance for about a year now. If you are in school or in a grace period, again, these are all statuses where you're not required to make a payment. Your loans are in good standing. Don't worry, you're not going to be collected upon. Now, if you're delinquent, so that means that you've missed one or more payments, um, you are not subject to collections, but here's where you have to kind of keep an eye on your portfolio, because after 9 months of delinquency, you could be at risk of default. Now, you don't always go into default immediately after 9 months, but at that mark, when you know you've been 270 days or 9 months delinquent, you need to be thinking about, oh my gosh, maybe I really need to do something quick because you are on the brink of default. And then once you're in default, which it will say on your federal student aid account, you then would be subject to involuntary collections. So how do you know whether or not you're in default? You want to log into your studentaid.gov account. And then on the greetings page or the dashboards page, whatever comes up when you first open the account, you're going to see this kind of pinkish, peachish banner at the top, and it's going to tell you that you have loans in default. And then you're going to want to scroll down to your loan breakdown by servicer In this detail here, you can see each and every loan that's in default is going to have a little red default mark above it. Under the loan status, it should say default. Now, you can have there are situations where you may have some loans in default and some that are not in default. But this is the way, by going into the federal student aid account, you can look at the detail. Most people who are in default for all of their loans, but there are exceptions. So who's servicing your defaulted federal student loans? And this is important to know because at some stage you may need to make a phone call to the debt collector. So the vast majority of defaulted federal student loans are managed by the default resolution group. It's also, you might see it reflected on your federal student aid account as debt management and collection systems. That's the collection arm of the federal government. So that's going to apply to all Department of Education held direct loans, Department of Education held FELP loans. There are smaller contractors. ECSI is really something for Perkins loans. And I'm not sure that ECSI actually manages defaulted federal Perkins loans, but we'll double check on that. So that's gonna fall under the default resolution group umbrella. That's going to be the vast majority of defaulted federal debt. If you have an older type of FELP loan, it's called a commercially held FELP loan that is defaulted. Those would be with a guarantee agency. There are about 12 or 13 different guarantee agencies. Just as an example, I can tell you that for a lot of New York borrowers, it probably is a company called Trellis, which is based in Texas. Trellis, it used to be HESC here in New York State, but they got out of that business. They transferred all of their defaulted loans over to Trellis in Texas, and there are about 12 or 13 others. If you need contact information, you can click on this link and it gives you a full list and all the contact information. And it should say, by the way, on your federal student aid account, who your debt collector is. Much like it generally says your servicer, it would say your debt collector is either going to be Debt Resolution Group or one of these guarantee agencies. So if your loan is delinquent, and you want to address that before it gets into default, there are a number of things that you can do. You can call your servicer and request what we call is a retroactive forbearance. So let's say you've been delinquent for 5 months, and you want to bring the account current. You can call the servicer and say, "Hey, look, just have not been able to make these payments." They don't always, but they may issue you a retroactive forbearance, which would bring your account current. Doesn't mean that you're out of the woods. You're still going to have to come up with a plan for paying these loans off going forward. And it doesn't mean that you no longer owe the amounts that you didn't pay. It just brings the account current. It might also correct some issues with credit because after 3 months of delinquency, the servicers report the delinquencies to the credit agencies. But like I said, once you're in that forbearance, you're going to need to ultimately come up with a long-term plan to pay off the loan. So this is where you need to explore the income-driven repayment options or any whatever your most affordable option is to get your loans paid. If you still can't afford the payments, you can ask about longer-term deferments or forbearances that you may be eligible for. But just remember, again, this is not the long-term strategy for getting rid of your debt, but maybe it's going to buy you a little time to figure something else out, get a little bit more income, whatever it is that you need to do. The main difference between deferment and forbearance is how interest is treated. So in a deferment, if you have any subsidized loans, the interest is waived during the deferment. If in a forbearance, with the exception of the SAVE forbearance and other special forbearances like COVID forbearance, but in a normal forbearance, interest accrues regardless of what kind of a loan you got, whether it's subsidized or unsubsidized. For a deferment, once you come out of a deferment, any unpaid interest will capitalize, meaning it's added to your uh, principal balance, and then the interest is charged on that higher balance. For forbearance, any unpaid interest comes out. It still accrues, but it doesn't capitalize. So consequences of staying in default or going into default are that you may be subject to involuntary collections. And so we're going to go through what these involuntary collections can sometimes look like. So the federal government can garnish up to 15% of your quote unquote disposable pay without a court order. Remember, the vast majority of what the federal government can do, they can do it without taking you to court. If you have private student loans and those are in default, the private lenders have to take you to court and get a judgment before they can take any of your money. The federal government doesn't have to do that. They can just seize certain things. So, in terms of the way they garnish, it's 15% of your disposable pay. And disposable pay is calculated as your gross pay minus any mandated deduction from your paycheck. So things like federal, state, and local income taxes, Social Security, Medicare, mandatory retirement contributions, those would all factor into determining your disposable pay. What doesn't factor into determining your disposable pay, meaning it doesn't get subtracted from your gross pay, would be things that you like money that you pay for health insurance premiums, union dues, voluntary contributions to retirement, or any other wage garnishments that you might have outstanding. So the garnishment is going to continue until the debt is paid or resolved, and through one of the ways that we're going to discuss a little bit later. And remember that your employer is going to be required to withhold these wages by law. So a lot of people, this causes a lot of people a lot of anxiety, just because they're getting their employer involved in their personal financial situation, and they're concerned about the strain that that might cause on your relationship with your employer. So you obviously want to try to take any steps that you can to avoid this, so that you don't get to that point where you're having these kind of uneasy conversations with your employer. The garnishment process is that you will receive a notice of intent to garnish. You're supposed to receive these notices within at least 30 days before the garnishment begins. Once you get the notice, you have a right to request a hearing. And if you're disagreeing with the garnishment for any reason, you want to make sure that you respond to that request. And you generally can offer three different defenses for the garnishment, which is one is financial hardship, one being that the loan is not actually in default, or that there is sort of that there's an incorrect amount of debt that they're assessing you for. The other way the department will take your funds is through something called an offset program. So it goes through the Treasury and it offsets different benefits and Treasury related programs. The biggest one being, of course, Social Security. They can take your Social Security retirement or disability. They cannot take SSI. So if you are on SSI, they're not going to be able to touch that, but they can take regular Social Security retirement and disability. They can take federal employee salaries. They can take military benefits. And as we just recently found out, they can also take any proceeds that you might be due from selling federal assets like a treasury bond. And they can do it without notice. So there's a lot of different ways and a lot of different things that they can do if you're getting federal benefits of any kind. And then the formula for Social Security is they will garnish up to 15% of your monthly Social Security benefit, or an amount that just leaves you with $750. They cannot leave you with less than $750 a month. Now, once again, I just want to highlight here, if you are in default, even though they have announced, well, and they didn't, I'm not even sure that they announced it, it just kind of came out through the press, that they have paused Social Security offsets for now. You want to take this time to address this issue so that once they restart, because eventually we assume they are going to restart the Social Security offsets, you are not subject to that. The offset process, the loan is going to be sent to collections via the debt management system. So Default Resolution Group is the servicing arm of the debt management collection systems. The Treasury offset is initiated. The notice is sent Now I have had one client that has gotten one. It comes from the Department of Treasury. And then if you don't respond to it or call them up and make an other arrangement or get yourself out of default within 30 days or a little bit more, the actual offset will take place. So they could start taking your tax refunds, your Social Security, retirement, and then all the other things that we talked about. Now, there is an automated Treasury offset program or top program helpline or hotline, sorry, that you can call here. It's the 1-800 number that I have here, which you'll give them your information, your personal information, your Social Security number, and date of birth, and that automated help hotline will tell you whether or not you're scheduled for an offset. So if you're concerned about that, you can call the line and get a little bit more information about timing of when you might be scheduled for an offset or whether or not you are scheduled for an offset. Tax refund intercepts, the government can seize federal and in some cases state income tax refunds, including the earned income tax credit and child tax credit. So that can be particularly severe for people with kids. If the tax refund is intercepted for a loan that's in default, and you're filing your taxes jointly, the spouse that doesn't owe the debt can actually request a refund by filing this IRS 8379 form, so that they can at least get their portion of the tax refund back to them. No prior notice is required before intercepting future refunds if the borrower is already in default and if you've received a notice in the past. So this seems to be a one-time notice type deal, lifetime of the loan. If you've received this notice 5 years ago, you may not get another notice saying that your tax refunds are going to be intercepted. Some additional consequences for going into default: you're no longer eligible for federal student aid if you're looking to go back to school. You don't have access to IDR plans. You will not earn any credit towards forgiveness programs. And of course, default damages your credit history, can be a relatively severe damage. And then, of course, in addition to everything else, you're at risk of accruing additional collection fees and interest that may be added to your accounts, which could increase the total amount of debt that you have to pay off once you get out of default. So how to contest an offset or a garnishment? Again, you want to request a hearing promptly. The wage garnishment notices give you the notices are a little different in terms of how you go about requesting the hearing, but you just want to follow the directions on the offset notice. Again, with the wage garnishments, you have about 30 days to do it, although you could do it once the garnishment begins. For offsets, it's a little bit looser. There is no specific deadline. But again, if you're subject to a Social Security offset and you want to contest it, you want to request some kind of a hearing or a package to reduce or eliminate your offset. And you can do the grounds for dispute. It could be that you've already paid your loans, or the loans are not yours, or you don't have any loans in default. I've recently had a client that actually doesn't have loans in default that received one of these notices. Or you're experiencing some kind of a financial hardship, or if the loan is not legally enforceable, meaning that you're in bankruptcy discussions, or meaning it was discharged in bankruptcy, or you got a discharge through borrowed defense to repayment or some other type of discharge. And then just pay attention to the documentation that they request that you submit. If you're uh, requesting a hearing or you're contesting it on the basis of hardship, you want to make sure, in addition to your income information, that you provide proof of expenses as well. Okay, so the good news about federal student loans is that there are two avenues to get yourself out of default if you find yourself in default. And the two ways to do this are loan consolidation and loan rehabilitation. So we'll walk through each one in a little bit of detail. Starting with loan consolidation, this just replaces your existing defaulted debt with new loans, new direct consolidation loans that are in good standing. Um, it's a relatively simple process, can be done online. If you do it online, you must choose an income-driven repayment plan as a means of paying your debt back, but that's what most people would want to do anyway. Um, and you can complete this process well, in the past, you could complete it in about 30 to maybe 30 to 45 days. Now I would say maybe up to 3 months. The consolidation portion alone is usually a little bit quicker right now because of the delays in getting into an IDR plan. It could be up to 3 months before you complete the entire process. But relatively speaking, it's going to be quicker than the alternative option, which we'll talk about in a minute. When your loans default, when your federal student loans default, there are two um, negative remarks that go onto your credit report. There is a delinquency that led up to the default, and the default itself, which shows up as a collection item. Now, when you do a loan consolidation to get yourself out of default, it doesn't affect your credit report at all. So if the defaulted loan is on the credit report, it's going to remain on the credit report. Both derogatory remarks will remain there. But keep in mind that federal student loans, defaulted federal student loans, and delinquent federal student loans do age off of credit reports after 7 years, just like regular consumer debt. The difference is that just because it ages off your credit report doesn't mean that you don't owe the money. And that's a big distinction between private loans and federal loans. Private loans have a statute of limitations, a date by which the lender must take you to court to collect their money. There is no statute of limitations on federal loans. So if the loans are a defaulted loan could be on your credit report, or if it's very old, it may not be. And if it's very old and not on your credit report, then this issue in terms of impact on credit is not a factor in determining which is the better way for you to get out of default. It's going to restore your eligibility for benefits once you're consolidated. Any unpaid interest and fees is going to consolidate when you do a consolidation, is going to capitalize when you do a consolidation. However, if you do the consolidation online for loans that are directly owned by the Department of Education, you may avoid capitalizing excess fees. In terms of public service loan forgiveness and IDR forgiveness credit, so this is not so much true of PSLF, but for IDR forgiveness, if you've accumulated any qualifying payment credit for that, that's the 20 to 25 years of qualifying payments. If you accumulate any credit towards that forgiveness program and you consolidate right now, you may lose that credit. PSLF has its own set of rules whereby if you have credit, you've already accumulated credit on direct loans that are defaulted and you consolidated, you wouldn't lose all the credit. You would get a weighted average credit post consolidation. Number of times you can do a consolidation. It really depends on what kind of loans you've got. You have to have something to consolidate loans with. At some point, you may have just done all the consolidation that you can do. So if you have one direct consolidation loan, or if you have one direct consolidation unsubsidized loan and one direct consolidation unsubsidized loan, you're as consolidated as you can get, and consolidation would not be an option. In terms of stopping collections, it's going to stop immediately once the consolidation is completed because you're going to have a new loan. But remember, you cannot do consolidation if the loan has an outstanding wage garnishment or judgment. For loan rehabilitation, this is a process. It's a little bit more cumbersome, a little bit more, takes more time. You make 9 monthly payments as agreed upon with your debt collector over a 10-month period. The entire process probably takes 10 to 12 months to complete, and you really need to be on top of it at every step of the way to make sure that you're meeting your goals. Um, a successful loan rehabilitation will remove the default status from your credit report, but not the delinquencies that led up to the default. It's going to restore eligibility for all the benefits that we talked about before. In a lot of cases, interest is not going to capitalize when you do a loan rehabilitation unless you have a commercially held FFELP loan. And so a loan rehabilitation keeps the original loan intact. So any credit that you've accumulated towards IDR forgiveness or towards PSLF will be there once you complete the loan rehabilitation. Currently, you can only do this once successfully. Again, we talked about with the new rules, if they come into effect, you will be able to do it twice. And you can stop a wage garnishment or an offset after making 5 qualifying payments. You can do a loan rehabilitation with an administrative wage garnishment, but you cannot if there is a court judgment against that loan. So some considerations before getting out of default. In some circumstances, particularly when it comes to rehabilitation, the post-default payments may differ from the payment that you were making during the rehabilitation. So you need to be sure that you're going to be able to afford the basically when you come out of the rehabilitation, you're going to have to enroll either in an IDR plan or in a standard plan. And you want to make sure you can afford that payment because it may be higher than what you agreed to pay during the rehabilitation itself. You also need to be aware if you're going to be in an income-driven repayment plan, which most people do when they come out of default, you're going to have to keep up with the annual requirements for renewing that plan, because if you don't, you could wind up back in default again. And then there are some circumstances where you may want to consider staying in default. It's rare, but it does come up. If the garnishment or the offset is less than your expected payment once you come out of default, then maybe you're better off just staying in default, particularly if you don't care about your credit or if it's like really old and it's aged off your credit report. There are other even rarer situations where you might consider temporarily going into default just to avoid an affordable payment. But in either of these two circumstances, you want to reach out for advice before you do something like that. There's limited times when when you want to exercise those strategies. And then, of course, in terms of choosing the right repayment plan. So, when we do this 3 months or 4 months from now, this might be a different landscape, but there are generally two different ways to make payments, either the traditional payment route, which assesses payments based on the size of the debt, the interest rate, and a predetermined payback period. The fixed versions of those plans are like paying back a traditional consumer loan, like a mortgage or an auto loan. You make a monthly payment, and at the end of it, you paid everything off, including all of the interest. The alternative would be the income-driven repayment plans, IDR. That's includes income-based repayment, pay as you earn, income contingent. It had included save. Right now, you can't do anything with save. Might be a more affordable alternative to the traditional plans, offers 20 to 25 years of forgiveness. Traditional plans don't. They are sometimes required if you're pursuing certain forgiveness programs, and it's going to be best suited for people with large loan balances and low to moderate incomes. So I'm going to leave it with that. Right now, you can file an application. They are starting to process applications after long periods of not processing them on all the repayment plans except for save at this point. We did want to mention one quick thing about the IDR forgiveness program. So again, this is the 20 to 25-year forgiveness. During the Biden administration, they had a program called the IDR account adjustment that provided that awarded borrowers retroactive credit towards IDR forgiveness based on a set of relaxed rules. So you were getting credit retroactively for periods that you might not have otherwise gotten credit for. So periods where you may have been in a forbearance or certain deferments, or periods where you were not enrolled in an IDR plan, you got credit for all of that. You had to have had a direct loan or have filed a direct loan consolidation application by June 30th of last year in order to benefit from this. You could also have had Department of Education held FFELP loans and benefit from this. And for a brief period of time, the department had placed a tracker on your federal student aid account where you could actually see the results. Unfortunately, they've taken that tracker down. However, the raw data is still in the system. And if you want to get it, what you do is you log into your studentaid.gov account in the same browser that you are logged into that account. You're going to take this link that I provided here, put it in that browser, and then it's going to create this kind of ugly looking file right here. If you see the pretty print box at the top, you want to check that because it's even uglier if you don't check it. You want to copy and paste that or download it and save it for your records. It's confusing. You may not be able to read it, but we can read it, and there are people out there that can read it. It's your records. It probably makes sense for you to download and keep it. And this goes to the whole issue of what's going to happen with people who have accumulated credit in all of these IDR plans. If they make you switch to the IBR plan, now, under the current rules, if you accumulate credits in Payee, Save, or ICR, and because of the litigation, they say that you can no longer get forgiveness through those plans. Those payments will transition to the income-based repayment plan once you transition to that plan, assuming you're eligible for it. So there's a lot of stuff going on with this, but it can never hurt to have the information in your possession. Reach out to us if you just have a question about what to do with it or how to read it. And then finally, there are basically three strategies for managing debt, because you always, at the end of the day, do want to figure out your long-term strategy for tackling your debt. And from our experience of seeing thousands of clients over the last 5 or 6 years, people basically fall into one of three buckets. The first being pay your debt as quickly as possible. So this is going to be for people who have relatively high income compared to their debt balances. They can afford to make more than the required payments or make lump sum payments. If this is your strategy, you want to, and you can, the faster you pay it off, the more you're going to save overall over the life of the loan because you're saving on interest. It may entail making higher monthly payments or lump sum payments to do it, but if you have a loan that was supposed to be paid off in 10 years and you can pay it off in 7, you're going to save 3 years worth of interest over that time. The second bucket, which is where most of our clients, frankly, tend to fall, is identify some forgiveness program, whether it's public service loan forgiveness or IDR forgiveness, which is a longer path to forgiveness, um, that you're eligible for, and make the minimum required payments until such time as you achieve forgiveness. So again, this is going to be for people who have larger loan balances, low to moderate incomes, or you are pursuing one of these forgiveness programs. In these instances, you only want to make the minimum required payment. You don't want to pay extra towards your debt, because the whole point is that you're not going to be paying off the entire thing. And then finally, pay the minimum required until death do you part. As sad as that sounds, we do put it here for a reason. This is, for the most part, going to be for older borrowers that maybe took out late in life loans for themselves or took out Parent Plus loans, and now they're either approaching or at retirement. So they really can't go the PSLF route because they're no longer working. And they may be faced with paying the loans back over a 20 to 30-year period. And if you're 50, 60, 70 years old, that could mean the rest of your life. So what you want to do is just identify the cheapest repayment plan for you, make that payment until you either pay it off or until you pass. And the reason that we mention this is because a lot of people don't realize that, unlike most consumer debt in this country, um, federal student loans are discharged when the primary borrower dies. So if you are making those payments, the minimum payment that you can find to make, you can just rest easy that once you pass, the burden will not pass to your family or your beneficiaries. And that's it for the presentation. When you get the deck, I just want to call attention, if you're not already on it, and I think most of you probably are, that we do have this newsletter that you can subscribe to get regular updates, and Lord knows there's been a lot of them, and try to keep yourself up to speed with what's going on with this ever-changing environment. And if you need to contact us, again, we have a helpline. You can book an appointment online, or you can use our program email to get in touch with us. So with
And
that, Lena, I'm gonna,
yeah, there were like really good questions that I'll remember to add maybe a slide in the future to this deck. The questions were around private loans. Um, So generally, and this is good information, even if you don't have private loans and in the future you may have kids that are going to college and you're going to be exploring your options. Now, the landscape may change by then if you still have a few years to go, but under the current options, we generally say that there's no reason why someone should be getting private loans because the federal system allows the student and parents to borrow up to the cost of attendance, which basically is whatever you're going to need to afford the school. The student will have a cap on how much they can borrow. Total under the 4 years is about 31,000. But the parent could borrow a lot more and up to the cost of attendance, whatever that gap is. Now, it is my understanding, and I am aware that some schools don't really tell parents that they can actually borrow and the benefits of borrowing from the federal government. Or they may tell them, but somehow they also push them into private loans. Now, with private loans, the student is liable, and there's usually a cosigner, which is usually a parent. The cosigner is 100% liable for the loan. And what we see in our practice is a lot of clients come to us because they're struggling to repay and they will likely fall behind, meaning going to delinquency and default. Usually it's the same difference with private loans. Not the only, but the most common option to reduce a payment for private loans is generally lowering the interest rate. Some private loans are going to have fixed or variable interest rate. We saw that when the interest rates were really low, a lot of parents were taking out or students were taking out a lot of the private loans because the interest was amazing, like 3%, what have you. Those interest rates might have been variable, and now they have gone up to 11%, 12%, and the payments are no longer affordable. So all this to say, if you are in that situation where you're dealing with a private loan, I do encourage you to reach out to us to have that one-on-one session. Usually during our session, we are evaluating short-term and long-term ability to repay that loan and discussing consequences should the loan not be paid, meaning what does it look like once you stop payment and the impact on credit and all that. We are also very lucky in New York that we do have a partnership with the New York City Bankruptcy Project. So in some cases, we will refer you to a bankruptcy expert just to discard or to better understand what would that look like. I'm not saying you're going to file for bankruptcy, but I think it's helpful to get a second opinion on your case. Um, Again, there's just a little bit much more to say about private loans where it definitely requires that analysis of ability to repay short term and long term. The reason why I say that is in a lot of my cases that I've worked on, I have clients that come to me 5, 10 years later, still trying to maintain those loans in good standing for the right reasons, but not realizing that to pay it off, it's going to take them 20, 30 years. It's just not realistic. So rather than be in misery trying to tackle a loan for that long, you really want to explore your options. You want to understand the consequences if you don't repay it. But I always say it's like easier to just pull the band-aid than like waste years and a lot of resources for a debt that may never be repaid. I am not pushing anyone to not pay their loans. We just need to face reality. So all that to say, please reach out. There's an entire conversation we should have in those situations. And that's it. Thank you.
That's it.
Oh, I
I
should say, I did put in the chat, there was a question about people on the safe forbearance. What was the repayment due date or the forbearance extension? The forbearance apparently has been extended to October 31st, 2025. According to my staff, I always say monitor your servicer account to make sure if you're on the safe forbearance when your expected due date is.
and on that note, like I said, yeah, and if the legal case kind of lingers on, they basically every time they get close to the end date of the forbearance, that save forbearance, they just keep pushing it back if the legal issues have not been resolved. And even if the legal issues are resolved as of October 31st, it's not likely that you'd be making a payment anytime soon after that because they still have to find a way to transition you out of that plan. So I'm just, there's one person with a hand raised, so I'm gonna just take that question. So Arnell, if you want to unmute yourself, if you're able to do that. Let's see. Doesn't look like you're, I don't know, we're not seeing you unmuting. So um if you have a question for us and you're unable to unmute yourself, you can just follow up with an email to us and we'll be happy to answer that for you. Okay. With that, I think we're gonna wind it up just pretty much in time. Oh, we see one more. So one more person raised their hand. Um, but I think at this point, it doesn't look like anybody else has a question. So I'm going to wrap it up. Thank you all for attending. Feel free to reach out to us if you need individual one-on-one help, and have a great day.